The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. This is Betsy Ricks with Blue Vault Partners. We appreciate you participating in our webinar today. We wanted to start off with just a couple of housekeeping items. If you did not include your 6-digit CFP ID when you registered for the webinar and you would still like to receive your CE credit, if you would please contact me directly. Again, it's Betsy Ricks at 678-456-4640, and I would be glad to take care of that for you. We will be taking questions at the end of our call today. If you would you have two options for those questions. You can submit them online through the webinar program itself, or you can hold your question until the very end, and we will take verbal questions. It is best, however, if you're dialed in through your phone line, and then you will need to enter your PIN number in order to ask a verbal question. Again, we'll take those at the very end. I'm going to turn it over to Stacy Chitty, one of our managing partners, and he's going to kick us off today.
Thank you, Betsy. We want to welcome everyone to this Blue Vault BDC webinar, and we want to thank you for taking the time to register and participate with us today. As a research firm with a heavy emphasis on education, the purpose of this webinar today is to provide you with a higher level overview of non-traded business development companies and how they should be evaluated. As most of you are aware, Blue Vault was founded in 2009 to provide fact-based research and transparency on the non-traded REIT investment offering. But earlier this year, we decided that we needed to add to our research platform the BDC, or Business Development Company, investment offering. We did so by partnering with Blue Springs Capital and Jared Schneider. We consider Blue Springs and Jared to be experts in this field and of analyzing BDCs, and together we launched our first BDC quarterly research called the BDC Review for the second quarter of this year. We are releasing, incidentally, the third quarter BDC Review next Thursday, December the 12th, for all our subscribers. Jared will be leading our webinar today, and we are thrilled to have so many of you sign up for the webinar. In fact, there was only room for 100 participants, and 130 signed up. So we'll probably be doing the exact webinar again very soon so that others can participate. There are numerous financial advisors, broker-dealers, and BDC sponsors all on the call today. With that said, I'll now turn it over to Jared. Jared?
Thank you, Stacy, and thanks everyone for joining this afternoon, and if you're on the West Coast this morning. It's a pleasure to go through these new investments, relatively new, and explain and help all of you understand these investments a little bit better and teach you on how to evaluate them. Just real quickly about Blue Springs Capital, we are a private equity and advisory firm helping business owners exit their businesses, as well as providing research and advisory services. We also do fund formation consulting for new funds, and in the past I worked at CNL in their strategy group for their capital markets division, and have taken on numerous strategy and financial consulting jobs, and have my MBA from Rollins, as well as, and this is what I'm really proud of this year especially, because I'm proud of my Seminoles, got my bachelor's at Florida State University. So what I want to talk to you today about is really what BDCs are, where they came from, what purpose they serve, and how you evaluate them. So getting right into what is a BDC. So a BDC is a business development company, which is an SEC-registered investment company, and it is taxed as a regulated investment company, or as a lot of people in the industry call a RIC. And the structure is very similar to a REIT structure. So 90% of the taxable income must be distributed to investors, and is a tax-efficient structure. But what does a BDC actually invest in? So BDCs have to invest at least 70% of their capital into U.S.-based private companies. And the reason why this structure came about was really to promote growth of U.S. businesses by individual investors. And so this is really a big thing for individual investors to have access to investing in private companies. So historically, only institutions and ultra-wealthy individuals had access to investing in private equity funds and private debt funds. But now individual investors can put their capital to work in these private companies and promote growth in the U.S. So these BDCs can also invest in either the debt or equity of companies or a combination of the two. So if they're investing in the debt, they are basically being a lender to the company. Otherwise, they're investing in the equity side as growth capital to these companies. So how does this process actually work? And it's similar to most fund structures. There is a group of investors that invest their capital in the BDC fund itself. Those funds are then invested into U.S.-based private companies. And when profits or interest payments, if it's a loan, get paid back to the BDC, those are then distributed back to the investors. So if you're investing in equity, those distributions might come at the end when you see capital appreciation from your investment. Or if it is a loan to the company, then those interest payments will flow through back to the investors. So where do BDCs fit in a diversified portfolio? So when you're looking at a diversified portfolio for your clients, you're looking at stocks, bonds, cash, and then for many of you, you will include alternative investments. And a BDC would typically fit in the alternative investments portion, which also includes real estate, oil and gas, managed futures, and investments like that, because it fits into the private debt, private equity portion of their portfolio. So it is a piece of the alternative investment allocation. So just to give you a brief history of BDCs and how they came about, the actual law was passed back in 1980, but BDCs didn't really come about until the 1990s and early 2000s. So these early BDCs were publicly traded entities and really didn't make much news until in 2004, Apollo Investment Group raised over $930 million in their public offering. So the issue that publicly traded BDCs run into during down markets in the stock market is that they have a hard time raising capital when markets are down. So for example, in 2009, when markets were at an all-time low, BDCs were trading at a value that was lower than the value of their portfolio. And so for the current investors, that was dilutive because other investors were getting in at less than what the value of the portfolio is, and it makes it hard to do a public offering when you're valued below what the value of your entire portfolio is worth. So then came along non-traded BDCs, and the first one came about in 2009 with Franklin Square's FS Investment Corp. And this was really in response to the opportunity of BDC investment, but really wanting that access to capital across different economic cycles. So the non-traded structure is great for a BDC because it allows investors to invest at high points and low points of the economic cycle, giving you great opportunities along the way. Now, the total BDC market is still relatively small when looking at other investment types. Both traded and non-traded BDCs add up to about $43 billion in assets. And while that might sound like a lot, if you compare that to the REIT space, there are close to $400 or $500 billion in assets in REITs. So it's still a newer market and still growing, and there's a lot of room for growth in the future. Now, just to give you a quick lay of the land of what the non-traded BDC market looks like, there are 9 BDCs currently raising capital, with 1 close to new investors, Franklin Square Investment Corp, and that is expecting a listing event sometime next year. So far this year, non-traded BDCs have raised over $3.5 billion, and the year is not over yet. So it is expected that it will be anywhere from $4.5 to $5 billion of capital raised for the non-traded BDC market by the end of the year. Now, these numbers that you see here on the chart are as of the end of Q2, and as Stacy said, we will be updating our new report, and that'll be coming out next week. So really this chart just kind of gives you a rundown of what the total assets are in the BDC, what the gross proceeds, their capital raise is so far year to date, what the yield is, and who is managing the capital. So now let's change gears a little bit and talk about how do you evaluate these BDCs, and what are you looking for when thinking about having your client invest in these. So we've identified 5 top ways to evaluate a BDC. So the number one thing is to look at the management team. Now, the reason for this, that the management is so important, is these funds are investing in private companies, and neither you or I can go in and research these private companies and look at all their financials and know how they're running their operations, because they are private companies. And so that's why it's so important to have a management team that is competent, that's been doing it for several years, and they have a specific strategy. So in looking at the management team here, you can see, for example, in our reports, we have a quick snapshot of how the fund is managed, how the investments are made, as well as who is actually behind the investments that are being made. So we will actually describe the type of business that the investing teams are in and how long they've been doing it for, and really just give you an idea of who is behind the fund. And I think that really helps you understand what type of fund you're really investing in. So also, too, another thing that you want to look at is what is the strategy behind this fund. Some funds will focus only on certain industries, energy and power, for example, and some will be diversified. Some will focus on large companies, some will focus on small companies, and some will focus on certain types of investment, whether it's debt or equity or a combination of both. So there are a lot of things to take into account when just looking at the management team and the strategy of this fund. But that's really the foundation of understanding what you're investing in. So number 2 thing is looking at the distributions. As of now, all non-traded BDCs are providing a distribution to its investors. Now, the thing that you want to look at is where are these distributions coming from? And to explain that a little bit more, the distributions can come from a few different places. They can come from net investment income, they can come from capital gains, or other sources of taxable income, or they can be provided by expense support. And so what happens is early on in the life of a fund, the parent company will typically help support the distribution as the fund is gaining momentum. So the parent company will actually be writing a check to the investors to help support the distribution that the investors are expecting. So For those of you that have worked with non-traded REITs in the past, although there is a payout ratio that we calculate that is somewhat similar to the FFO payout ratio that you might be used to looking at, it's really not the best measure of understanding the distributions, because many of the funds out there have it in their mandate, in their prospectus, that says that they cannot pay out of proceeds or borrowings. So typically you're going to see the payout ratio be somewhere close to 100%, whether it's under or just slightly over. They will typically target their distributions to follow the taxable income. They want to make sure that that taxable income is covering the distribution. So getting back to the different pieces of distributions, you want to be looking at that net investment income number, that NII. If you can see, I know it's small in that chart, but the NII is the net investment income, and that's basically all of the income, or if you're a debt-focused BDC, those are the interest payments that are coming in to the fund, and then you're taking out expenses, and that's what's left, the net investment income. And that amount should be covering most of the distributions. So it should either be a majority or all of the distributions. A lot of times capital gains will be covering a portion of that, and that's fine. But the thing you want to look for is making sure that capital gains aren't the vast majority of where the distributions are coming from. Because if you're selling investments at a gain every quarter, you can't expect that forever going forward. So you want net investment income to be the main driver of the distributions. And so the third thing that you want to look at is the portfolio performing and producing the returns to actually support those distributions? So it's taking it a step further and saying, now what's actually going on under the hood? What is the portfolio doing that is actually providing the distributions or the return to my investors? So we look at it a few different ways. We look at the return on equity, which is basically the GAAP earnings per dollar invested. So, and as many of you know, if you're looking at any public company, GAAP earnings are different than the cash flow that is actually earned for that period. So it's a relevant measure, but it's probably not the best way to understand the yield that's actually coming in. So we do provide that, but really what you want to look at and focus on is the yield to equity. So this shows the yield or the income that's being produced by the portfolio on your dollar that's invested, if you're invested in this. So that's really your signal to understand the number that's supporting the distribution. So for example, in this chart, there's a 10.4% yield on equity. If this fund is paying out a 7% distribution rate, then that should be covered in there. They should have no problem making that payment as a going concern. So the third number that we're looking at is the yield on portfolio, and basically what that is a similar number to the yield on equity. It's just saying what is the yield on all of the assets that are owned by the fund. And basically the difference between the yield on equity and the yield on portfolio is the yield on equity takes out the borrowing portion. So the yield on portfolio includes both owned assets and assets that are bought with borrowings. So the number 4 thing that you want to look at when evaluating a BDC is where in the capital structure is the fund mostly investing, what industries is it investing in, and does it invest in mostly fixed or floating rate investments if it's a debt-focused fund. So let's start with the capital structure, and as you can see in these charts, it'll break it down by asset type. So you're looking at how much of this fund is invested in senior debt, how much of this fund is invested in subordinated debt. It'll break it down by equity and so on. So the next portion also shows the portfolio concentration, and that's what shows you what industries this fund is invested in, as well as how concentrated it is in a specific industry. And what you want to look for, especially if it's a diversified fund, is that there isn't too much concentration in one industry or the other. So if you're expecting a diversified portfolio, then you should get a diversified portfolio across both industries and companies. So this just gives you a glimpse into how much of the investment dollars are concentrated in specific industries. And when you're looking at the capital structure, or the fixed versus floating rate structure, I'm sorry, the rates on the investments can either be fixed or floating rate. And if you can understand it, it's similar to a mortgage. So for example, if I'm lending to someone to buy a house and I think interest rates are going up, then me as a lender, I would want to have variable or floating rate loan to them, because that protects interest rates going up against me. And if I thought they were going down, then you would want it to be fixed. So it's the same concept with the BDCs. If the management team feels that interest rates are going to go up, they have a flexible mandate to move their investments more toward floating rate investments. And then that would protect you against interest rate spikes. So what is the capital structure? I'll just go into it really briefly. The capital structure, sometimes in the industry, is called the capital stack. And so it basically shows the priority that each investor section has on the individual company. So if you're looking at a company, the senior debt is typically going to be backed by assets. It isn't always backed by assets, but you'll hear a term, senior secured debt. And so what that means, a senior secured loan is basically a loan that is backed by assets of the company. So if I'm looking at a manufacturing company, the plant itself could be an asset backing that actual loan that I've made to the company. Below that is subordinated debt, and it will typically have a higher interest rate and will not typically be backed by specific assets. And then below that, you obviously have your equity, which is your higher risk, high reward portion of the investment. So the way that this priority term comes into play is that the priority comes in if there is something like a bankruptcy of the company. So for example, let's say a company goes bankrupt, and in the proceedings, what will happen is the senior debt holders will get paid first. And below that, the subordinated debt holders will get paid. And then so on to the equity holders. So as a senior debt holder, you have the highest priority of getting paid back if there is something that goes wrong with the company. And your trade-off there is you have a lower interest rate. So the fifth thing that you can look at when evaluating a BDC, and this is something that is a little bit different than how non-traded REITs have been evaluated. Because typically in a non-traded REIT, you don't get to see the historical performance, or you don't get to see the returns until there's a liquidation event. But the way that BDCs are, there's a requirement to report a total return number. And so this total return number is basically all of the distributions that have been paid, plus any appreciation to the actual net asset value, or NAV. And so taking this example, you can look at the year-to-date performance as well as past years' performance. And what we do in our research is we pull together 2 different indexes and compare them to the fund. So for example, this leveraged loan index that you see on the chart is an index of what someone called bank loans, or typically senior and floating rate loans. And that is the total performance of those type of loans in that index. The next one down is the Bank of America Merrill Lynch High Yield Index. And what that does is measures the total performance of mostly subordinated or junior debt investments that are not typically backed by assets, but have a lot of times a fixed rate investment. Now I'm talking in a lot of generalities because you can have subordinated debt that has a floating rate and vice versa, but that's typically how those loans and how those indexes will work. So moving on to the way that these are structured and a little bit about the terms of the BDCs themselves, we will take a look at the fee structure, which shouldn't be too foreign to most of you that are used to the non-traded REIT structure. So you'll have a maximum sales load of 10% with 7% sales and 3% to the dealer manager. Management fee of 1.5 to 2% of assets. And then there's also a performance incentive fee. And the way that this incentive fee is different than, for example, a non-traded REIT is that the performance incentive fee is taken on a quarterly basis based on capital gains and income over a performance hurdle rate. So a lot of other funds or other fund structures will have some sort of hurdle rate, but the incentive fee will only get paid at the end or at the liquidation period. And just to tell you a little bit about how the hurdle rate works is, and I ask you to bear with me because this might be a little bit confusing, but it just shows what might happen in a scenario with a hurdle rate. And so let's look at this example. So you're invested in ABC BDC, and it earns 10% on the portfolio for the year. And in the terms, the BDC has a 7% preferred return to the investors, and they have a fee, what's called a catch-up fee, which is 8.75%. And so I'll just explain what that means. If you earn 10%, if the BDC earns 10%, that first 7% of performance goes all to the investors. So they want to make sure that the investors get that 7% before anyone else is paid. After that, the next 1.75%, all the way up to 8.75% of that performance goes to the advisor or the management team. And that's basically what is called the catch-up. It allows them to catch up on their performance incentive. Anything beyond that, all the way up to that 10%, anything beyond that 8.75% is split 80% to the investors and 20% to the advisor. And really the way that this is set up, the hurdle rate with the incentive fee is a way to incentivize the management team to make sure that the investors are getting the return that they're expected, and if they perform above and beyond, then they get paid for that, as well as the investors. So it's really just a way to align incentives between the management team and its investors. So now you know 5 ways to evaluate these BDCs. You know a little bit about how these BDCs came about, and one of the things that a lot of advisors have come to us about is what are the red flags when I'm looking at one of these BDCs? What are some of the things that I need to know to understand if this is going to be a good investment for my clients? And I would say there are a few things that are what we call areas to watch that might be either red flags or just areas of concern. So things that you want to look at are leverage. You don't want the fund to be over leveraged, because that way if the portfolio takes a downturn, then that will negatively affect the investor. But so far, most of the non-traded BDCs out there across the board are not highly levered. So that has not been an area of concern in the industry yet. But with more funds coming in and more strategies and more management teams coming in with different ideas, that might be an area for concern in the future. So it's just something to watch, although right now it hasn't been an issue in the industry. The second thing that I would say is an area to watch is watching the distributions. If those distributions are too reliant on capital gains quarter after quarter after quarter, then that's not a sustainable way to provide distributions to your investors. It's great if you are performing like that and getting those extra capital gains, but if the net investment income is not supporting that distribution, then that's a reason to question whether it's a good investment or not. So another thing to look at is, like we talked about before, the concentration in either one industry or one company. Obviously, a industry-focused BDC like FS Energy and Power is not going to be an issue, because you want it to be 100% in energy and power, because that's what you're trying to get. But if you're looking at a diversified portfolio, you need to be diversified across industries. And so that's just something to watch for. And in addition to the company concentration. So you might be perfectly diversified across industries, kind of just looking across the board, but you may have one company in your portfolio that is a large portion of the portfolio, or is a large portion of your investment. So when looking at that, if 100% of your money is in one company, then you're depending on that one company to continue to perform and provide you with the return that you're expecting. So those are some things just to look at as far as the concentration aspect. Another thing is when the annual operating expenses are too high, then that means that the management team is not being efficient with the money that they're spending. So just to preface that, operating expenses in the early period of a fund's life cycle are going to be high, because you have certain fixed costs that you need to cover, and there's certain things that you need to do to get a fund up and running. And when there aren't many assets in the fund, and when you're trying to gain momentum, that operating expense is going to be higher. And what you should look for is that coming down over time. If that doesn't come down over time, then that would make you question whether they are efficiently using the money wisely. So the operating expense is, for those of you that use mutual funds, you look at the expense ratio, and this is something that is, it's not exactly the same, but it's about as close as we can come to in this industry. So it basically incorporates the management fee, the incentive fees, the general and administrative expenses, and that's all tied into one annualized rate. And so that shows up. I'll actually show you a quick table on the next slide. And another thing that you want to look for is on the distributions, if the expense support is not coming down over time and that fund is not performing enough to provide the distributions, then that would be a reason for concern. So if this parent company is writing the check for distributions every year or every quarter after quarter, and that is not going down over time, then that would be a red flag, because it means that the fund is not performing well enough to provide the distributions that you're looking for. And so obviously, just like the operating expenses, the expense support, if the fund is doing it, is going to be high early in the life cycle, and then it should come down over time as the fund performs. And this table will just show you some of those areas to watch. This is a key statistics table that we put together. It goes through the operating expense ratio. It shows you what the weighted average interest rate is that the fund is paying on its borrowings. It goes through the taxable income payout ratio, like I talked about, as well as some of the other metrics that are areas to watch for. So that really wraps up the bulk of the presentation. I just wanted to remind you that we are a resource. So, you know, if you contact either me or the people over at Blue Vault, we will try our best to help answer any questions you might have. I know there was a lot of information here, and it's a lot to take in, especially if you're not familiar with them already. So I hope you learned a little bit about how these investments came about, what they are, what they invest in, and how you can evaluate them for your clients. So now we're going to move to a question and answer session, and I really thank everyone for being on the call.
All right, this is Betsy again. If you have any questions that Jared can answer, you can submit those via the online program, or you can raise your hand and we will call on you verbally. Jared, our first question is from Mark Stevens. His question is, does the advisor catch-up fee carry over to a new year if the fund doesn't provide full 8.75% return?
That I am actually not sure about, and I think the terms will be different based on each BDC. I believe they can only look back every rolling 12 months, but that, again, that's something that's going to be different for each BDC, so you would have to pull up their prospectus and look at what those terms actually say, because every BDC is going to be a little bit different on that aspect.
All right. Our next question is from Carl Foreman. Can you address the state-mandated net worth limitations on such investments?
Again, this is something that ranges from state to state. So, for example, it could be a income of $70,000 and a net worth of $70,000, excluding a home. And for some states, I think it can range up to maybe it's $100,000 or $200,000. So it differs based on each state. If you look in the prospectus of each BDC, they should state that if they're signed on to sell in that state, it will have, toward the beginning of the prospectus, it'll have that outlined, and it'll give you the guidelines for that.
All right. Bonnie Paco asked, with regard to leverage, how much is too much?
Well, that's a great question. They do have a requirement by the SEC not to go over a certain amount. So And I will have to go back on that, but I believe it is 50% is the maximum. So if you're looking at a leverage ratio of 50%, they have reached their maximum, and the SEC will actually, as it stands right now, they will not let them borrow more than that. And I'll have to go back and check on that just to make sure, but I would say that you want to look at a fund that's, you know, up to the 40% range. You just don't want someone that is maxing out that amount. But the SEC does provide some protection in that by not allowing them to borrow too much.
All right. We have a question from James Ortlett. Can you explain exemptive relief and its importance to the success and performance of a BDC?
Sure. So the exemptive relief is basically something that the fund will apply for. And this is if they are working with a sub-advisor that also makes similar investments or investments that are in similar companies. So, for example, if you have a sub-advisor, which could be like a private equity or private debt manager, then you are asking the SEC to invest alongside their investments. So if my sub-advisor is making a $50 million loan to company A and I want to participate alongside them, I have to apply to the SEC to participate in that originated loan. Now, you don't have to have exemptive relief to make originated loans. It's just if you want to invest alongside your sub-advisor or affiliated company.
All right, we have a verbal question from James Kearney. James, I'm going to unmute you so that you can ask your question. Can you hear us, James?
Yeah, I sure can. In general, is the non-traded BDC world less leveraged than the non-traded REIT world, and generally, what is that industry differential?
I would say that if you looked back a few years, it would definitely be less leveraged than the REIT world. I think the REIT world, they have come down on their leverage since the downturn. However, I do think that a lot of REITs maybe put on a little bit more leverage than the BDCs just because of the nature of the investment. So a lot of times in investing in real estate, you will add either a mortgage or kind of a blanket loan to that to help the returns and the distributions. However, it's hard to generalize now because they've come down, but I would say still the BDC industry is less leveraged than the REIT industry. And that's the non-traded BDC industry, because you have seen publicly traded BDCs go higher in leverage in the past.
Thank you.
All right, we have another written question from Carl Foreman. Are BDC investments more, less, or have the same liquidity as REITs?
That's going to depend on each one and how they structure their terms. But I will say generally the BDCs have a little bit more liquidity, although you are seeing REITs become more open to more frequent and larger amounts of redemptions or liquidity. But the way the liquidity works with a BDC is they might offer a tender offer to their investors at the end of the quarter, and that amount might be 2.5%, it might be 5% per quarter. So typically they offer more frequent and larger amounts of liquidity to their investors, and they will basically make an offer to their investors to get out, and it will be capped out at that whether it's 2.5% or 5%, whatever they determine in their terms.
All right, we have a question from Mark, and Mark, I apologize now, I'm going to mispronounce your name, Mark Mazanov. His question is, maybe based on history, what is the likely default rate and recovery rate in a recession? Not necessarily as bad as in 2008.
I do not have the information on the default rates, and really it's difficult to know because the first non-traded BDC came in to the space in 2009. However, a lot of the sub-advisors that are involved in the industry have had default rates of under 2%, and I'm just generally saying that. You know, that's not every single one across the board, but again, that goes back to, you know, making sure that your management team is competent and experienced in the space, because they are the ones that are underwriting these loans.
All right. Michael Miller's asked a question. Can you elaborate on how the NAV is calculated regarding the various types of loans?
Yeah, so simply the NAV is calculated as the total assets minus the total liabilities, and then divided by the number of shares outstanding. But when it comes to the valuation of the actual portfolio itself, and I don't want to get too much into the weeds for everyone on the phone, but there are different levels of valuation. So on one level, you can look at market information. Some of these investments that the companies have made are actually traded at some point, and so they look at those prices to use the valuation. And then some of them are never traded. If it's an originated loan, and there's no other way to value it except for internally, then that value is found internally. So they use a calculation, and in their reports they will tell you how they came to that valuation. So if it's a lot of originated loans or loans that aren't traded ever on the market, then you're basically subject to the valuations that they provide you.
All right, and we have another question from James Kearney. Do recent trends show non-traded BDC investments accelerating faster than non-traded REITs?
Well, they were. This year is becoming quite a big year for non-traded REITs and their capital raise. You saw, I believe it was 2011 is when most of the new BDCs were either filed or came effective, and they are starting to raise capital very quickly. I think last year the capital raised was maybe $2.5 billion, and already so far this year we've done $3.5 billion. So it is, the momentum is there, and I think people are recognizing the opportunity in this space, especially at a time when still a lot of banks are not making their typical loans, and that allows funds like BDCs to come in and investors to take advantage of lending to those companies.
All right, we have a question from Brandon Zvek. How should leverage be calculated for BDCs who utilize a total return swap? Would the leverage be simply the amount of collateral posted?
So in that calculation, what you are doing is, it's kind of confusing to say over the phone, but it is with the TRS assets, what you do is you take the notional value and subtract it from the collateral posted, and then that is divided by the notional value of the TRS assets. And that's in combination to any other borrowings that they have and assets. So the TRS makes the calculation a little bit more difficult, but that's how you would do it. And I can, if you need more clarification on that, we can, Betsy can connect us offline, and I can explain that to you.
All right, Brandon's question was our last submitted question, but we do have time for a few more. If you'd like to raise your hand or submit a written question, we'll hold on for another minute or so and just see if anybody else has anything. All right, well, we appreciate Jared's time today, and I'm going to turn this call back over to Stacy Chitty. He's going to give you just a little bit more information before we end the call. A replay of this will be available on our website next week at www.bluevaultpartners.com. Stacy, would you like to finish us up?
Yes, thank you, Betsy, and thank you, Jared. Great job and really, really good questions. So we appreciate everyone's participation. We want to thank you for calling in today, and we hope that it was very informative, but even more so, we hope that that you were able to learn something that you didn't know prior to the call. That's obviously the goal each time we do this, and that we helped add value to what each of you do. We are going to make it a priority to do more educationally based webinars throughout 2014, so we hope that you'll join us again and be on the lookout for different subject matter. And if you have feedback on subject matter that you would like for us to include in future webinars, please let us know. If you have questions or follow-up questions about the call today, about BDCs, or subscribing to Blue Vault's research, either non-traded REIT or BDC, then please feel free to contact us. You can reach us online at bluevaultpartners.com. About 3 weeks, I just want to mention one thing of importance. About 3 weeks ago, we released what we consider to be an unprecedented study on non-traded REIT full-cycle performance. We did the performance calculations on 27 total full-cycle liquidations. And you can learn more about this study at our website or by calling us. But everyone who has sold or sells REITs or has ever sold a REIT really needs to own this study. It's kind of the be-all, end-all of total performance on non-traded REITs. And with that, and also just please feel free to provide us feedback on the call today. That's how we can make these calls better in the future. We hope you have a great day, and this ends our webinar. Thank you.